What's up guys, Jake here. In this video, we got to do another update to my brokerage account challenge. In the event you don't know who I am or what I'm doing, check out that playlist I will link down below. And I was down 8% today, or about $3,700. This has not been a good week and a half for my account balance. I was so close to being doubled up at 50,000. The positions in this video are current as of Tuesday, May 18th, and the market is kind of just trading a little flat. It was slightly red on Monday and then slightly red again on Tuesday. And I'm only up 67% now on my cost basis from January 1st. This is trading day 94 of 252, current as of May 18th. If you want to see my positions in my last update video, you can pause the video to see percentages or what's changed. I'm obviously going to go over exactly what has changed. My account now looks like this, and I have not added any new positions, but I've added new call contracts. Additionally, I've exited 2 positions. At any time, if you go to the community tab on my YouTube channel, you can always see my most current positions. Last Wednesday, the market kind of had a freak out, and there was a sharp dip in a single day. And that actually, I viewed it as a stress test of which positions I'm currently holding that are the strongest. When the going gets tough, who's going to panic sell, who's sharing these positions as me. And the 2 companies that I thought performed the best was HCA and Celanese. So for that reason, I wanted to add more to these positions. So I bought additional call contracts. Now, they have different strike prices, obviously, because I want to buy the closest out-of-the-money option. But I feel like these 2, I feel like investing in general, people are quick to add to their losers and then sell off their winners once they've made a gain. And that's actually inverted thinking. Usually, if something's going down, you want to cut your losses. And if something's going up, you want to get on that train. So with HCA and Celanese performing pretty well last week, I felt like they needed a larger position in my account. And then the 2 positions that I closed out is Viacom and Sherwin-Williams. I was hoping for a green Monday so I could get out of both Home Depot and Sherwin-Williams. However, they were both down on Monday. Sherwin was up a little bit today, so I think it's overvalued at this point. It's gone up so huge. But let's first talk about Viacom. And this was a put that I sold. So I sold to open for a premium of $250. Now, I haven't made $250 unless the contract expires worthless or I buy it back and then I receive the difference. So Viacom was negative for quite some time. I made a video about Viacom and Discovery. We'll talk about Discovery in a second. And these puts have been a huge pain in the butt. I regret getting involved in these. There's a reason why you get paid a higher premium for dealing with these stocks that have experienced stress, I guess, in the last couple weeks. But let's think of the math of what I made on my money from selling a put contract. I haven't sold many puts in this challenge. I mostly buy calls. But let's just think about the math here. So I sold it open for $250. I then had to exit it by buying back for $108. So my profit was $141. Now, the buying power, the collateral that I locked up was $4,100 for 25 days. What is the equivalent annual percent yield on my money for that 25 days? And it's 50%. I earned the equivalent of 50% APY on my buying power for these 25 days by selling this put. Not a bad deal. If you want to know exactly how to calculate that, take your profit, divide it by the collateral, then divide it by the number of days you had it locked up, 25, multiply it by a year, 365, and that gives you the equivalent APY, or 50%. Pretty amazing. Now with Sherwin-Williams, this was a call that I bought, so I bought to open at $1,400. I sold to close today for $2,400. So I made about a $9,000 profit when you factor out the cost of getting in and out of the contracts. Here's my Excel spreadsheet from all of my swing trades until I stopped trading individual stock. These are all of the calls and puts that I've sold, and these are all the calls that I've bought. And nothing is negative yet. I'm being a little bit stubborn. I probably should get out of Adobe and get out of Clorox because they're down and they're not going anywhere. But I haven't sold or exited any position yet for a negative, and I'm doing my best to avoid that. There's no reason to. There is something called a sunk cost. By leaving my money there when it's not doing anything, it doesn't serve me any good. Every day you stay in a negative position, that's a day you're choosing for your money to remain there. Even if it doesn't go down any farther, if it's not going up, if you could sell that position and redirect that capital somewhere else that is going up, there's an opportunity cost constantly there. And I'm well aware of this, but I am being a little irrational by holding on to positions like Adobe and Clorox right now. I still think they can get back above their cost basis, but I haven't sold anything for a negative, and I'm doing my best. So let's talk about the stocks that are currently blowing up my account right now, and we got to talk about the home builders. This is D.R. Horton, ticker symbol DHI, and the Pulte Group, ticker symbol PHM. And these were the IT stocks about 2 months ago when they took off in March, April, but with that stress test last week, everybody freaking out about inflation and the cost of building materials going up and potentially shortages on all the materials that home builders need to build homes. It's caused a steep decline. Same thing with Pulte Group. These stocks are basically trading identical, and I think I just timed it absolutely terrible. The fundamentals still look good, by the way, and I'm still expecting on their next quarterly earnings that they're going to have monster numbers. They're still making cash hand over foot here, or fist over mouth, or whatever that expression is. But once again, how sustainable is it long term? People who invest in stocks want to say, how is this company going to be doing a year from now, a year and a half from now, 2 years from now? And are these stocks going to be staying hot, come this fall? I knew what I was getting into when I jumped into them. I even said in the videos, there's a hype around these stocks. But the fact that they blew up, they burst right in my face a week after I jumped into them, that is just bad timing. That is maybe that's a sign. I don't know, but I'm down huge on these two positions, and if I can just get back above my cost basis, I'll be happy. I feel like with Home Depot reporting this week that might have had some effect on them. So we got to just give these two stocks another week or so to breathe and see if they can equalize. I don't see them going much lower than where they currently are, but has the uptrend halted? Probably. Let's now talk about potentially the biggest news story the last 2 days, and that was AT&T is spinning off their media empire, their media subsidiary, Time Warner, and they're merging it with Discovery. This was not expected. Like, Archegos was pumping up this stock. Did they know that this deal with AT&T was coming? There was the margin call. It's been on a steep decline the last 2 months. Holy cow. So let's go through the details one more time. I'll link a couple articles for you down below. But basically, AT&T 3 or 4 years ago went through a huge ordeal to acquire Time Warner. They wanted to become a media conglomerate in addition to their telecommunication services. So they spent an obscene amount of money, something like $80 billion to acquire Time Warner, which owns CNN, owns HBO, the new streaming service HBO Max. So AT&T spent all this money and financed it entirely with debt to acquire WarnerMedia, and then before that they also acquired DirecTV, spun that off to a private capital company. But they pretty much have botched everything they've done the last 4 years. Like, how the board of directors or the CEO still has their job after all of this, I don't understand. But what AT&T is doing is they're spinning off Time Warner and they're merging it with Discovery, but they're sending the debt with them. The debt that they acquired to accumulate the company, They're now giving up the company and its cash flow with the debt to Discovery. So people who own stock in Discovery and people who own stock in AT&T, they're trying to figure out who's getting screwed in this deal. And right now, investors are saying both of them. So let's look at these. Let's look at these stock charts for the last 5 days, because I was sitting at my computer on Monday morning watching, Squawk on the Street when they were talking about this. And initially, both stocks on the news shot up huge. Usually when there's like a stock split or a merger or something, usually creates a lot of excitement. So Discovery was at 35 and it shot up to 38. So it went up $3 a share. That's pretty cool. And AT&T was at 32 and got as high as 33.71. However, people who were holding Discovery said, wait a minute, we just inherited all of AT&T's debt. The thing that was holding back AT&T stock, its massive short-term, long-term debt and the interest they have to pay on it, we're now responsible for it. So Discovery's stock collapsed. And with AT&T, they said, yay, we don't have all this debt anymore. We're a more streamlined, efficient company that's going to focus on telecommunications. But oh no, all of our cash flow is gone. We're going to have to cut the dividend now. So now AT&T is crashing. So this is fascinating to watch. If you're holding either one of these, you might just have to hold them for a while. And there's going to be a new ticker symbol created. So if you hold Discovery, you're going to get shares of the new company. And if you hold AT&T, you're still going to have AT&T stock, but they're going to give you shares of whatever this new company is that's merging Time Warner with Discovery. So let's back out to the 3-month mark and look at these red bars showing the massive sell-off. Because once again, this is a dividend stock. People were holding this for the 6 or 7% dividend payout, and it's getting cut. It's getting reduced. So is AT&T a buy once the sell-off ends? Where is this going to bottom out? I think AT&T stock's going to go much lower, definitely below 29, 28, 27. So watch for this and see how low it goes, because that actually might be a good time to enter AT&T. Now, ideally, once it's gotten rid of all of its debt and Time Warner, maybe its share price can start performing as well as T-Mobile. T-Mobile seems to be the hot stock ever since they merged with Sprint. Next stock we got to talk about is Home Depot, because this is a bust that I got hit by, and I knew this was coming. I knew this was going to happen. However, we got caught off guard last week. So my intention was to sell Home Depot before earnings. However, the market took a dip 5 days before Home Depot's earnings. It wasn't able to get back to all-time highs, and I'm still positive, but I know I can get more for this call contract. So Home Depot reported its earnings this morning, and we'll just look at the 1-day view. What did it do? Okay, it was at 318, shot up to 324, and then just kind of equalized. Well, how good were their earnings report? And they were phenomenal. If you ever want to see a company's earnings report, just go to Google, for example, Home Depot financial statements, then go to Home Depot's website. We want to look at the quarterly earning they just posted, and then click on their press release to get the PDF. So let's just show you how phenomenal these numbers are and how absurd it is that the stock did not go up. So net sales, this is in billions of dollars. So a year ago, this was during the pandemic when Home Depot was an essential retailer and you actually could shop there. They did $28 billion in sales. A year later, so May 2nd, 2021, they did $37 billion in sales. That is a 31% increase in same-store sales. That means a lot if you understand what same-store sale increases mean to a company. A 32% increase. When we look at their net earnings, profits of $2 billion up to 4.1. That is an 84.6% increase in net earnings. Their earnings per share, the The consensus was that they were going to do $3.08, and they got $3.86. They absolutely crushed it. You literally could not have a better quarterly earning report for Home Depot. And what did the stock do? Absolutely nothing. It just froze. It just stood where it was. So let's think about what's happening. And everybody knew that their earnings report was going to be good. It was already getting priced in during this giant movement upward here. And I think people want to know, how sustainable is this for Home Depot? What's Home Depot going to do with all of this extra cash? Are they going to buy back stock? Are they going to increase their dividends? Are they going to reinvest the company somehow that can make them more profitable in the future? How they're going to do that hasn't been divulged yet. So people don't want to sell, but they also aren't willing to jump in and buy it. So what I think is going to happen is everybody's waiting. They're waiting to see if it'll go any lower. There are lots of people that want to buy Home Depot. If you look at the long term, let's look at their share price over the long run. So we'll go to the max view. Look at that stock graph. Why wouldn't you want to be holding Home Depot long term? But everybody wants to get in at a discount. So I think Home Depot, they're going to give it a week or two, or maybe a month even, to just let it drift and see if it will go any lower. And if it doesn't, that's then the time to buy. So I definitely think Home Depot will get back up to its all-time high. Is it going to do it this week? No. I was hoping to unload this if it got back to 330 before the earnings reported, but now that I'm trapped in it, I'm just going to hold it and hope to still be there once it finally starts going back up, which I'm confident in the next month or so it will. So let's recap all my contracts, and with that put that I sold on Discovery, I'm going to get assigned, and this is going to be really weird because I'm going to have to start selling covered calls on it to get back above my cost basis. But at some point, this stock, it's not going to be in the immediate future, but at some point in the future, this stock is going to get converted to the new company that Discovery is merging with Time WarnerMedia. So who knows? Wells Fargo, still thinking about selling once it gets back above 50 a share. Home Depot, I'm now in a wait and see period. I might buy another call contract on Home Depot if it does drift lower in the next week or two, because once again, people are waiting. They love this stock. They're waiting to get into it. With PHM and DHI, I effed up. That's my bad. And I just want to get back to basically my cost basis or back to their 52-week high. I don't think that's going to happen. So if I can get back above my cost basis, I'll be happy. Same thing with Clorox. I should probably just get out of this. It's not going to go anywhere anytime soon. Adobe, I still think this will eventually start channeling and get back above 520, and then it'll probably drift back down to 475. With the rest of them, I'm still happy with these. Once again, I'm really confident in HCA and CE after last week. Let's see, Allstate is still doing great. I'm still comfortable with Facebook and Universal Health Services. So these are all looking still good. Okay, guys, for those of you who wanted this challenge to keep going, I did this for you. I deliberately screwed it up and got set back this week so that we could keep this going. Maybe another month. I didn't think it would still be going. Oh my gosh. Thanks for watching. If you enjoyed this video, give me a thumbs up so the algorithm knows it's good. If you have any comments or questions, let me know down below. I love hearing from you guys. Till next video, take care.